This podcast is kindly supported by Resolute Investment Managers Inc. and 91 Asset Management. Resolute Investment Managers Inc. is a diversified multi-affiliate asset management platform that partners with more than 30 best-in-class affiliated and independent investment managers. It offers a unique platform that delivers strategic value through the full suite of distribution, operational, and administrative services available to affiliates and partners. 91 Asset Management is a global asset manager with emerging markets roots that brings a different perspective to active and sustainable investing. Our next guest was once a chemist whose love of card playing and probability led him to a career in investing. Hear how he likes to go off the beaten track, not only on his motorcycle, but also in investment and the insights he's bringing to the Cleveland Clinic Investment Office, as well as to governance. I'm Aoife Devitt, and welcome to the 50 Faces podcast, a podcast committed to revealing the richness and diversity of the world of investment by focusing on its people and their stories. I'm joined today by Brent Mattis, who's a principal at Cleveland Clinic Investment Office. He specializes in idea generation, investment strategy, and manager selection for the investment portfolio, and likes to look off the beaten path for opportunity. Prior to joining the Cleveland Clinic in 2017, he worked for 6 years in a family office in New York City, with a particular focus on alternative assets, direct private investments, and public equities. Welcome, Brent. Thanks for joining me today.
Hey, thank you, Ethan. How are you doing today?
Great. Well, let's start where we always start, which is a little bit of background. Can you talk us through your background and career journey, starting with where you grew up and what you studied?
Sure. So I grew up in St. Louis, Missouri, and I was lucky enough to go to a great public school. And there I had some great teachers, and one of whom showed me chemistry, and I got really passionate about chemistry. And what was great about her is she sort of let me run free in the laboratory and more or less let me do whatever I wanted. And so that curiosity and that passion led me to California. And so I went to UC Berkeley for my undergrad. And at UC Berkeley, I really sort of put my head down and studied and graduated really with a degree in chemistry. And at that point, I almost myopically focused on what I could do with a bachelor's in chemistry. And so I went to work for some drug discovery companies in San Francisco, where I was doing medicinal chemistry, which is synthesizing small molecules to look for cures for cancer, arthritis, other diseases. And on one hand, I really enjoyed the process of discovery, the art and the science of it. But what I found was that with a bachelor's in chemistry, there really was no upward mobility. You really were expected to carry forward other people's projects. You were not really in a position to contribute a lot of thought genesis. And so I decided to get my MBA. And the catalyst for that really was in my spare time, I was doing a lot of reading, specifically about economics and macroeconomics. There was an author named Jim Rogers who wrote a couple of books on investing. One was called Investment Biker, where he took a motorcycle kind of all over the world and was, buying securities on the Botswana Stock Exchange. And I thought that was so exciting. And at the time I was also a motorcyclist. And so, I sort of fancied myself like a macro guy. And so I went to business school, and in business school, it was great to meet people who came from different careers, because I'd say almost embarrassingly, I didn't know what consulting or investment banking were before going to business school. And so in business school, I got to do a lot of networking with people of different backgrounds, really learning kind of what their prior careers like, what they wanted to do afterwards. I think a useful heuristic for people in business school is the people that you choose to hang out with in business school, figure out what careers they came from. That might be the career you want to choose for you. And so for me, a lot of the folks that I gravitated towards were people who came from investing in some kind of capacity. And so I thought that might be a good path for me. But the actual thing that led me to investing was, interestingly enough, poker. In high school and earlier, I was really interested in all kinds of games, including a game called Magic the Gathering, which I know sounds super nerdy. I mean, I was pretty nerdy. I played in some local tournaments in St. Louis. And as I got older, I stopped playing, but I sort of followed the game a little bit. And there were a lot of very successful Magic the Gathering players who transitioned to being professional poker players. So I thought that's kind of interesting that they're taking this skill set that they've developed, the ability to read people, the ability to understand probability and strategy, and turn it into money. And so I read a great book called Harrington on Hold'em. I went to a school in New York City called the School of Cards. And that sort of taught me that I could really learn to play poker and play it decently. And this was a long time ago. So online poker was very new. And there was a format of play called rush poker. And what made it special was whenever you folded a hand, you would immediately be taken to a new table with all new players. And so you could play 200 hands an hour. And so if you developed even a little bit of an edge, you could start to slowly and steadily accumulate chips. And that sort of decision-making process of incrementally making slightly better decisions than the market and doing it on a repeated basis sort of formed a piece of my future investing philosophy. Two other related books were Super Forecasters by Phil Tetlock and Thinking of Bets by Annie Duke. And so I'd say one of the lessons or skills or theories about investing I have is one of the best ways to generate alpha in our seat today is to make a lot of small incremental bets that are incrementally more correct than the market. And importantly, not to make any big bad bets. If you can do those two things, make a lot of small bets that are slightly better than the market and make no big bad bets, that's how you sort of accumulate the kind of alpha that we're looking to generate here at the Cleveland Clinic Investment Office and knock on wood have.
I love it. We're straight into the investment philosophy, and we'll definitely revisit a little bit that poker side of things, which I don't think I'd known before this. And interestingly, you talk about catalysts, and I think we'll have to see how many chemistry-related vocabulary we can weave into this podcast, because I'm sure there's quite a lot of overlap between that, but that was great. So we know how you got into investing. Let's go a little bit back to science, because you talked a bit about how poker, card games, thinking about betting and probabilities has affected your investment philosophy. But before we move into that, how do you think, being a scientist and having hypotheses and testing them, do you think you've imported any of that discipline into your investment approach?
What I would say is chemistry is like investing in the sense that there's an art and a science to both. People focus on what is your beta, what's your alpha, what's your Sharpe ratio, but there's a whole degree of art necessarily in investing. And in chemistry, people think about the theory, what molecules are, how they bond together, what reagents you need to use. But there's also a lot of healthy art to it. When you're in a laboratory, there's many ways to accomplish the same thing. And only through kind of skilled, repeated practice can you figure out what the right approach is to start with. And so I think thinking logically, forming hypotheses, testing them, those all carry directly over from chemistry into investing. But as I'm not a chemist anymore, but somebody who still really loves medicinal chemistry, I've sublimed that interest into cooking. So I do a lot of fermenting, curing, smoking, braising. I think I'm cooking 2 chuck roasts right now. And so I know that in 2 hours, those are going to be delicious.
Well, now that everyone's obsessed with Lessons of Chemistry, that Apple TV series, as well as the book, I think we'll have to look at a stage 2 with an investing angle, perhaps. But let's fast forward now to your role at Cleveland Clinic. Quite appropriate that you ended up in a medical institution, given your roots. Can you talk a little bit about the profile of that investment portfolio? And I will put links in the show notes to the recent podcasts with your COO, because that's great background. But let's look at the focus of the investment portfolio there today. Can you paint a picture a little bit?
Sure. Yeah. At a high level, the Cleveland Clinic Investment Office, we oversee the balance sheet capital, the pension capital, and insurance capital for the Cleveland Clinic Foundation. We're a global healthcare system with facilities in Northeast Ohio, Florida, Abu Dhabi, Las Vegas, and London. And what we really do here inside the investment office is serve as a source of investment return and liquidity for the rest of the clinic. The clinic is very protective of its credit rating. And so our portfolio, if you were to look at it compared to other ENFs, it's more conservative and it's more liquid. So I think in traditional ENFs, you tend to see 5% to 10% in treasury-like fixed income. Here we run with about 30%, and most of it's investment grade. And in a lot of endowments and foundations, you tend to see 50 to 60% or more in illiquid assets. Our illiquids are around 30%. But other than that, it's the same traditional food groups. You've got equities, fixed income, private credit, private real assets, public real assets, venture, hedge funds, and buyout.
And do you reveal the size of the asset pool there?
Yeah, our assets are about 12 billion on the balance sheet side, about 1.5 billion on the pension side, and the reinsurance pool is very small.
And what's at the forefront of your mind now as you look at the opportunity set? You've listed a long list of areas you invest in.
Yeah.
I suppose, where we are with this inflation cycle, this interest rate cycle, reaching new highs in equity markets, recording this at the beginning of 24. What would you say is rising to the top in terms of opportunities and thoughts on your mind?
Yeah. Well, taking a step back, just going back to the inception of the office, we were insourced about 7 years ago from an OCIO. And so we've had 7 years together as a team to really kind of restructure the portfolio, keep managers that we liked, change out managers that we had differences of philosophy with, and sort of create a portfolio that we really like. And so, knock on wood, the portfolio has performed either at or above our expectations. And so really a lot of what we do now is the blocking and tackling of maintaining that outperformance. So unlike in prior years where most of our flows were in, since COVID, most of our flows have been out. So we've been a source of liquidity for the clinic because, as you can imagine, as a healthcare system, we are effectively structurally short inflation. Most of our revenue is on annual resetting contracts. So as you can imagine, if inflation is ripping, our labor expense goes up, our medical device and drug expenses go up, our utility expenses go up, but our revenue doesn't keep up. And so it's hurt us on the operating side. And so unlike in prior years, we've really had to be thoughtful about where we get liquidity from. And in particular, when our liquid assets fell in 2022, it was very challenging. And so a lot of it was triaging, trying to take capital from things that had worked. So we had a lot of commodity exposure, which was very helpful. We had systematic macro, which is very helpful. But kind of on a go forward basis, I'd say right now we have a few major projects underway. I'm sure Sean touched on some of them, so I'm not going to retread a lot of ground there, but we have a new holdings-based risk system we're implementing. We have a new machine learning-based data management solution so that we don't have to kind of manually go into every portal and manually download every file and manually put them into our CRM system. So that would save thousands of man hours a year when that project's wrapped up. Another big focus for us right now is on what we call core relationships. So these are large investment relationships that we have with outside managers. And there, we're trying to get more creative about making it win-win for both us and the manager. So that can be anything from seeding new products to developing custom mandates to doing co-investing through them. So that's a core area of focus for us in 2024. Another major project that we're working on is on the subject of pod shops, multi-manager, market neutral, multi-strats. That's an area that has really exploded in the last 3-4 years. And so it's causing people to wonder whether some traditional mandates, all the talent is flowing into pod shops, or are pod shops themselves creating some kind of systematic risk. So we're sort of looking at both sides of that question because we have traditional hedge funds and pod shops in our portfolio. I'd say another area that I'm spending a lot of time on is the flow of risk from bank balance sheets to insurance balance sheets. Basically, since the collapse of SVB and Silicon Valley Bank and First Republic, bank regulators are increasingly clamping down on banks that have a lot of unrealized losses from their mortgage-backed securities. And so it's the view of myself and a lot of other people that the provider of a lot of the senior capital in a lot of structured credit is going to move from bank balance sheets onto insurance balance sheets. And so if there's a way we can be a part of that intermediation or flow, that's an area of exploration. European credit is another area of fascination for us because we have a de minimis amount of exposure, but I think compared to the US, it's a much less crowded field. A lot of US players have stubbed their toe in European credit and sort of have retrenched and focused on their core geography. And so I think that's leaving room for specialist managers in Europe. And then I'd say expanding our co-investing program is another very active area for us because we have a co-investing program in private equity. And so it's relatively logical to expand that into probably private credit, private real assets, maybe our hedge fund program. But those are some meaty subjects for the next kind of 2 years for us to focus on.
Absolutely. And I'd love to pick up on a few of those threads. First of all, that's fascinating thoughts around the flow of risk, because we remember during the '08 crisis, it wasn't just the banks, of course, it was the likes of some of the insurance companies that certainly hit AIG, et cetera, that hit problems. And I think that was kind of almost a second derivative. So how do you, kind of taking that logic, think about the private credit market today, which is stepping in to mop up much of this lending capacity?
Yeah, you're covering the subject that I am very close to. So I think private credit is going to soak up a lot of the sort of investment opportunities that were formerly held on bank balance sheets. I think people are talking about the golden age of credit right now, and I sort of bristle at that, because when you look at base rates, they're very high, but when you look at spreads for a lot of more efficient parts of private credit, they're relatively tight. I mean, there was a window in Q3 of 2022 where spreads gapped out for traditional direct lenders, but then spreads have tightened again. Private equity sponsors are very happy to take down the fairway direct loans. Where I think there's still a lot of opportunity is in the private credit structures that are not down the fairway. So this can be things like capital solutions, it can be asset-backed finance, it can be the residuals of structured credit. I think there's still opportunities there, but you have to be very cognizant of what some of those structures are going to do in a recession, because it's been a very, very long time. In fact, longer than a lot of investment careers, the last time you had a recession that lasted more than 12 months. You have a recession that lasts more than 12 months, something like closer to the GFC or the dot-com crash, and their long sustained defaults will drag down the returns of a lot of private strategies and reveal that a lot of them were not as surefire as people have thought.
Well, no, absolutely. And I suppose we have a little window into that when we saw the banking crisis that I think you mentioned, the SVB banking crisis a year ago now. And I suppose thinking about that, making a resilient portfolio, you mentioned your liquidity, sensitivity around liquidity and needing to keep a high credit rating. Do you believe in hedges? And some of these pod shops, maybe you mentioned, were structured to provide hedge. Do you hedge your portfolio to make it all weather? How do you approach that?
We do rely on some implied structural correlations. So we have equities as our primary risk driver in the portfolio, and fixed income is intended to be a counterweight to that, because historically in recessions, interest rates fall, which typically benefits fixed income. However, in 2022, the correlation changed, and so we suffered losses on both our equity book and our fixed income book. So where we have sort of attempted to diversify some of that risk, we have a lot of public real assets, which are lowly correlated to both of those. And then we have our absolute return book, which is structurally designed to have no correlation to equities or rates. That means that we don't have a lot of high octane equity long short managers. Most of our managers are intended to be either market neutral or have low correlation to equities. And then we do have some things that are very diversifying. So they're not tail risk per se, but we have a couple of systematic macro funds that can benefit from down markets. Because if there's anything that recessions have shown us, sometimes they trend. And so trend following can benefit from that. And so our trend following manager that was in our portfolio was up in March of 2020, and they were up the first 9 months of 2022. And those were the absolute times we needed them to perform, and they did. So we think about the relationship between fixed income and equity risk. We think about our absolute return portfolio. And we're exploring some other more creative sources of downside protection. There's some strategies that are based on kind of decompression trades that I think are really interesting that we just haven't had the capacity to underwrite, but we're getting around to it.
I know it's not a chemical term, but can you define a decompression trade?
Yeah, a decompression trade. So normally when you have two kinds of credit spreads and one trade's tighter than another, and they're tightly correlated, during real big risk off moves, the riskier moves much wider than the safer. So there are a few hedge funds which specialize in putting on these trades where when markets don't do anything, you don't really lose much money because you're funding one side using the proceeds from the other. But when risk spreads blow out, risky stuff blows out much more than safe stuff. And so decompression trades are a way to play that.
Well, thank you for that. And one of the other threads I wanted to pick up on actually leads us to the next topic, which is governance. And it was really just building on the partnerships that you are seeking to build now, meaningful partnerships with really two-way flow. And I think it's a way certainly to enhance an investment office when you can rely on partners to offer some tools, etc. Thinking about that more broadly, because I think that is a trend of institutions of your size, what governance models, given you've worked in many different institutions, do you think are optimal for a group of your size in order to tackle the environment, the complex environment we're working in today?
That's obviously the hot topic for every allocator. And I feel like I've worked at two very different extremes, working for a single family office that had sort of one decider that was managing about $500 million, and working for a $13 billion allocator that's part of an 80,000 person healthcare system. So it's something that I think a lot about. And so a lot of my thoughts are based on conversations I've had with my peers, books that I've read and have influenced me. But I'd say the number one sort of necessary feature inside of an investment culture to be successful is meritocracy. It's really the notion that the best performers under whatever sort of framework you want to define that really have the chance to shine. Next piece that's critical is creating the right structure to encourage the team to balance risk and reward. That's a very open-ended point, but it's very challenging to do. You have to create an environment where it's safe enough for people to take risk, but if they're right, they can really benefit, because otherwise people will hew towards whatever little narrowly defined benchmark they have, which means that you're sort of leaving returns on the table that could otherwise accrue to the benefit of your stakeholders, which is why I think we're all here. Next piece that's critical is this delegation of authority. So when I look at highly successful organizations, the market is too big for one person to see the entire world, right? So where I think you have people who are really, really close to the situation, a really good culture has a way of pushing authority and decision-making down as far into the organization as it can really have. And so that goes all the way up to the board. So boards fully delegating authority to investment offices, CIOs, having sort of a trusted layer that they can delegate to is really critical. Holding team members accountable. So that's another sort of core theme. When people say they're going to do something, they got to do it. I mean, that's why we're all here. That's why we show up. That's why we work hard. It goes back to the balancing of risk and reward, but it's separation of process and outcome. I know that sounds kind of funny, but making sure people understand that you can have a good process and a bad process. You can have a bad outcome and a good outcome. And so not confusing the two. If it was a bad process that led to a good outcome, that's not good. If it's a good process that led to a bad outcome, that's not good either, but it's different, right? Because none of us bat 1,000. All of us make mistakes. But good processes, as I said earlier with the sort of repeated game, good process should over time lead to good outcomes. And then kind of lastly is just allowing teams to move quickly. Markets move quickly, managers, evolve quickly, co-investment opportunities come and go, seeding opportunities come and go. So the ability to move quickly has extreme value. The ability to move assets from one area to another has extreme value. So in general, like the more nimble a culture is, the better. And so that makes large organizations just more challenging because you have more stakeholders to get buy-in. And then I think there are some sort of notable organizations which I think have sort of threaded this needle. I'm thinking of groups like Verger, Ascension, Spider. They have sort of evolved their processes over time to embody some of the values that I sort of lay out.
It's fascinating. And I think what you mentioned about action and speed is important, because I heard a great quote the other day, which was to be impatient about action, but patient about results. Because I think, that's what we don't want to be knee-jerk short-term investors, but equally when we have decided to do something, inertia in the implementation, that can be where value gets lost.
Well, I mean, to back up a little bit, moving quickly and not making huge mistakes can cut against each other. Because one of the advantages of a more deliberate culture is when big ideas get proposed, there's a lot more time for them to be digested, discussed, thought about, sort of evaluated. And so there is a lot of value in deliberate thinking when it comes to making really, really big decisions. I think Jeff Bezos might have a framework about this. Like if it's two-way decision, you can make it very quickly. But if it's a one-way decision, you have to really think hard before you move forward with it. I like that framework.
And let's talk a little bit about some mission statements that other peer institutions might have around, say, diversity or being a medical institution, maybe investing in biotech or in the medical field. Does Cleveland Clinic have any such direction of travel? And maybe what are your thoughts on the diversity in the investment industry as a whole? A lot of questions there.
Yeah, sure. So, I mean, as a not-for-profit healthcare system, we are definitely mission-oriented. We have some investment guidelines that, for example, we're not going to be investing in tobacco. That's kind of a no-brainer for a clinic. But there's also some follow-on that are a little nuanced, like we're not going to be doing cannabis lending. So that's sort of a corollary of being a healthcare system. I'd say because we're a healthcare system, we do have a little bit of an overweight to biotech and healthcare. We have a colleague named Hunter who spends a lot of his time on biotech in the healthcare industry. He came from the sell side as a research analyst, so he has a lot of insights there. In terms of diversity and inclusion, I mean, we're part of the industry. So I've always been looking for talent in all places. And as I mentioned previously, I'm a very strong believer in meritocracy. And so there's no monopoly on talent. And so my last 3 interns have all been diverse, and they've all gone on to do great jobs in investment banking, investment management. And so I'm really proud of the mentorship that I've hopefully been able to give them. I'll let them speak to that.
We'll do a follow-up podcast with them. But you've talked a lot about the influences of what brought you to investing, whether that be some of the card playing and the probability analysis, and also the science background. Looking back at maybe any highs and lows so far since you've been in there, and I always like to ask about the lows, as they always exist, and the question is what we take from them. Anything to mention there?
Yeah, happy to discuss the lows of my career. So as I mentioned previously, I was a chemist, and then I went to business school. And really, I spent sort of 2 years figuring out where I could see myself fitting into the industry. And funny thing happened on my spring break of my second year in business school. A small investment bank blew up. It was 2008. And I was like, that's not going to help my recruiting efforts, is it? And no, it didn't. I graduated from business school with no job, no prospect of getting a job. I remember reaching out to Tuck alumni who were very, very helpful with their time and with their input. And the piece of feedback that I got, which really stuck with me, was, why would I hire somebody with no investing experience when there's a legion of laid off Lehman Brothers bankers who will work for very little right now? And I'm like, oh, that's a really good question. I don't know. So I really had to work hard to find an opportunity. I mean, it was literally me putting my possessions on my back and riding my motorcycle to live in New York City. I lived at 125th and 5th in Harlem, and I rented a room, and I was looking for a job while studying for the CFA level 1. And then this gets to the personal challenge aspect of it. My mother was diagnosed with terminal lung cancer. And so I really dropped everything and moved down to Florida to be with her and to help her and to make sure she got treatment. And it was tough. I mean, looking for an investment job in Florida in 2009, in 2008, it was very hard. And so I started doing GMAT tutoring just to keep income flowing in. And luckily, I had a really good relationship with a gentleman who worked in the career development office. And he introduced me to a gentleman who was at a hedge fund who needed somebody who had love and passion for technology and a background in tech and was looking to work hard. And so I had a remote job in 2009, and I was working on project work for a hedge fund. And that was really how I started to develop some understanding of how to invest, how to do individual company research, It was part of an activist campaign. And so that was really the catalyst that led to me joining the family office in New York City. So it started very rocky and got even worse. But I had a lot of people who were very good sources of advice and mentorship, and I landed in a great place.
That's a great story. And thank you for sharing some of those lower points, because there will be many, especially as we're not in a recession yet, but I'm sure there will be many graduates coming out in a similar boat. There's not a lot, the great resignation is not exactly as suppose as quick as it was before, or as active. So I totally understand that point. You said it was bad, it got worse, and it got so much better again. And I think that's the important thing to know, that it is cyclical often our careers. And you mentioned some people that really made a difference there in that trajectory. Was there any, I know this is never an exhaustive list, but any one or two key people that were influential, and in what way?
Yeah, I would say I'd highlight two of my bosses in my career. My first boss at a company called Rigel, which was a drug discovery company. Her name was Usha Ramesh, and she was one of not just the most brilliant people I've worked with, but one of the most brilliant people I've met. She was incredibly smart, incredibly talented, and she really taught me the value of hard work and excellence. And what made working with her so fun is, in addition to putting our heads down in the laboratory and getting the work done, we could talk about anything in the world. We could talk about politics in India. We could talk about what uranium prices were doing. We could talk about what ethanol subsidies exist. I mean, her intellectual interests were very wide ranging. And so for somebody like myself, who I work in the investment industry, and so I have a sort of very broad remit, it was a great match. And so she really brought a lot out of me. And then my current boss, a gentleman named Tim Compton, who's our managing director of credit, he embodies what I've heard is called servant leadership. It's a style of leadership where you try to elicit the best out of the people who work for you, and your goal is their growth. Tim has been a great mentor. He has encouraged me to not only work hard, but care about my family. Not like I need coaching there, but it's nice to have a boss who understands that we're people in addition to being investment professionals. And he has given me a lot of coaching on, I'd say, the softer side of the business. So how we relate with other people, how we interact with them, how certain things we say or do might be perceived or misperceived. So he's helped, me embrace some of the softer skills in the business. And so I'd highlight those two. Outside of my office, I would highlight a gentleman named Jay Collier. He was a managing director at HHMI, or Howard Hughes Medical Institute. We overlapped on several deals back at the family office that I used to work for. And he had this incredible knack for going down rabbit holes and finding niches that not a lot of other groups were in. And so his embracing of complexity, esoteric industries, securities, has always sort of stuck with me. And so it's kind of a hallmark of our private credit portfolio, which is a little bit more, I'll call it eclectic than I think a lot of other much bigger groups that have to put out $500 million a year.
That sounds fascinating. And my last question gets to some of the wisdom and just the life learnings that you've distilled from these experiences so far, maybe the people, or maybe any advice for your younger self.
Yeah, I would say prioritize what you really want in your life. That is critical. I had a conversation with one of my friends and mentors in the business, and he's a gentleman who from the outside has it all. He's built an incredible business. His style of investing is extremely interesting. And as we were talking about what I want out of life, he sort of took me aside and said, okay, you can see these things from the outside, but let me tell you how it really is. And he laid out personal sacrifices he made in his relationships with his loved ones that I wouldn't say he regretted them, but he really encouraged me to think long and hard about what I really wanted in life. And as he was saying that, I really came to the conclusion that there's no amount of money in the world that would cause me to sacrifice the relationship that I have with my wife and kids. And so I don't know how that sounds to other people, but I think that's really important to me. And then the other piece of advice I would give a young me is don't rush through school. You're there to learn. That's obviously why you're there. But I went to Berkeley and I studied very, very hard, and I took way too many units, and I graduated early, which meant that there was a lot of time I did not spend thinking what other options I had other than sort of pursuing the two immediate paths laid out in front of you as a chemist. Go to work as a chemist or go to get your doctorate in chemistry. And also you're there to meet people. That's another key thing about school. You're surrounded by all these incredibly interesting people, so get to know them. This is a thread that I've carried with me into the investment business. A lot of what we do can be, in essence, thought of as co-opetition. We are competing with other people, but we're also their friends and we cooperate. So I spend a lot of time now getting to know people on a personal level, understanding what they're looking for, what they need. Do they need ideas? Do they need capital? Do they need people? Do they need to, whatever they need? I like to meet them because what I think is when you do favors to people, when you make introductions that would never have otherwise happened, people remember. And when you help somebody when they're in their time of need, when you're in your time of need, there's a good chance that they'll repay the favor. So I'm a big believer in take time to, I think it's called smell the roses when you're in school and really get to know people, because ultimately getting to know people is going to be one of the most valuable skills in your career.
Well, thank you so much, Brent. A very human-centered end to a podcast that's been filled with both art and science and very human-centered throughout. I have the image of you taking us off the beaten path on your motorbike now, which is a slightly more colorful image, through topics as varied as smoke meats, poker, and decompression trades, among other wonderful words of wisdom. So thank you for coming here and sharing your insights with us.
Thank you very much, Ethan. I enjoyed myself.
I'm Ethan Devitt. Thank you for listening to the 50 Faces podcast. If you liked what you heard and would like to tune in to hear more inspiring personal journeys, please subscribe on Apple Podcasts or wherever you get your podcasts. This podcast is for informational purposes only and should not be construed as investment advice, and all views are personal and should not be attributed to the organizations and affiliations of the host or any guest.